wanted to ask you interesting facts about you. One was rock climbing. You've been into rock climbing in the past.
So
Okay.
I do climb. I really enjoy it. There's a super high correlation between people who work in tech and climbing. So if you ever want to meet a disproportionately high amount of Asian software engineers for whatever reason, just go to your local climbing gym. I'm not a software engineer, but meet half the criteria. It is strangely overly Asian represented. I don't know why that is. But it is also very tech heavy. Like I don't run into a ton of like traditional finance people because I think it's perceived as a bit of a crunchy activity. But yeah, I climb quite a bit, and that's been quite enjoyable. And it's definitely a sport gaining popularity because it got added to the Olympics as well, and I think that added
Yeah,
to its visibility.
that's really cool. I know you had as interesting facts for you was rock climbing and used to be a StarCraft 2 programmer too, right?
Pro gamer, yeah. I was a professional esports player on the last big esport before people made money playing. So
Yeah.
maybe had I chosen one game later, I would not be in tech at all. I'd just be a streamer. But yeah, there was an interesting period of my life where I was ostensibly a professional esports player. And that was really interesting. Yeah, I you know, played a lot of video games, I suppose, and
Yeah.
made a little bit of money doing so, which was cool.
That's great. That's amazing. Good stuff.
Very cool. Awesome. Well, Kevin, let's jump into your background. So tell us, right now you're at your company called Repool. We'll get into that, but let's, kind of walk us through your background and bring us to where you're at today.
Yeah, so Repool, in short, is a tech-enabled hedge fund back office software and services provider. And in particular, we do two flagship things. One is we actually do what we call fund in a box, which is end-to-end fund launch, and then the ongoing back office services. So fund administration, compliance and filings, banking, and then, from my view, biggest of all, software to really modernize what is a really antiquated services experience amongst traditional incumbents. And then the other product line is just the standalone admin, which is something that you get when you do end-to-end fund launch. But of course, if you already have a fund and you're not launching it, and or you simply want to do things the quote unquote more traditional way, then we have a strong standalone fund administration offering as well. So we're a venture-backed company. We did Y Combinator in summer 2021 for anyone who knows what that is. And then we have a bunch of traditional Silicon Valley VCs who have funded us and are backing our journey as a relatively new player in the fund administration and services space.
That's great. That's excellent. So I guess stepping back a little bit further, prior to Repool, kind of what does your career look to this point? What led you to start and found Repool in the first place?
Yeah, so I have a pretty orthogonal path into hedge fund back office services. Most people in the space that start these companies were at an existing fund services provider, and then they kind of spin out and start their own. And they're very good at what they do. But I think what that leads to is when you are not a tech person, you've never been in tech, and you say, I'm going to start a more tech-enabled firm, the extent to which that's true is, I think, pretty de minimis. Like maybe it's marginally better, but you don't really achieve that like step function leap into modern technology that you've seen affect many other areas of financial services and obviously consumer and other B2B. So our background, or my background in particular, was about a decade at various high-growth venture-backed Silicon Valley software companies. So actually nothing to do with finance at all. And my thesis coming into the space as an outsider was realizing that a lot of the workflows and work streams that fund services back office providers need to provide are actually very first principles oriented. And what I mean is fund back office, of course, has a lot of expertise, but you're not actually like facilitating the trading and execution of a strategy. So a lot of what the fund admin is doing is ultimately after you produce the accounting and the net asset value and whatever core things the fund needs from a reporting perspective, it's a question of, well, how do I distribute that to my investors and LPs? How do they interface with the fund? How do they get to actually give more capital, remove capital, subscribe? And so when you actually abstract away the hedge fund part, it's actually just common business problems that tech companies are really good at. So for example, I worked at a CRM company in the past. A lot of the problems that fund managers have are really actually similar to any company that has a CRM, right? You need to build a list of prospective LPs. You need to push them through and have them subscribe. Once they subscribe, you need to manage them. You want to understand what they're doing, both pre and post investment. That's actually just like a very similar set of problems to, something that any other company can solve. But fund admins traditionally don't have very good solutions for that. In my background and my experience, I have a lot of strong views on what is a great experience there. So simple questions like, if I was an investor, how would I want to onboard into a fund? How would I want to navigate really complex forms and workflows, almost like TurboTax for taxes, right? Like fund admin has a lot of these opportunities to build really nice technology solutions that make the lives of both the managers better and easier and faster, and also for investors. And we just didn't see a lot of that. So my thesis was there's a really interesting opportunity to blend Wall Street expertise, which we can hire for from an accounting and back office and compliance standpoint, with Silicon Valley technologists. And that's very much what we're doing at Repool, right? Is our team is an interesting blend of Silicon Valley backgrounded engineers and product folks, but then most of the actual like specific skill set folks come from other fund administrators or other multi-strat firms and bring that kind of Wall Street or hedge fund expertise.
Yeah, absolutely. That's great. Yeah. And it's definitely interesting in the space, right? And obviously myself and Mike come from fund admin background ourselves. So we understand the pain points and challenges with technology fragmentation, all the different things people are using. And it's been very antiquated over many years. I would argue, if anything was good about the pandemic, it pushed a lot of the fund admin firms into a digital environment. They even up until recently weren't really doing. I mean, DocuSign is I would say it's a recent phenomenon for most fund admins out there, which is kind of blows people's mind when you say that. But it's very much integration with technology, most using third-party systems and tools, which is fine, but they're not integrated, right? So
yeah, they're not integrated, and I think there's often folks who are in the hedge world are very good and very smart on the trading and financial modeling side and all this crazy stuff that is way too smart for me in candor, but they just aren't aware of the tooling that's available that has made it possible for non-financial services businesses to scale and find a lot of leverage, right? I was actually at a conference recently and it was like an amusing moment. I was in this roundtable panel section about marketing, and someone literally asked this older hedge fund manager, has anyone using the MailChimps? And if you know anything about email marketing, that's a really funny way. It's almost like asking how many marijuanas did you do? That technology has been around forever. It's really old. It's not at all the cutting edge. And it was almost phrased as if this was like some profound new discovery. It's just like 15 years in the past. And so I don't think that's a criticism. It's just you can only be good at so many things. But ultimately, a hedge fund is a business. And there are so many areas of the business other than the core mission. In the hedge fund's case, it's to deliver alpha, manager LPs. That's by and large your number one focus. But you have so many other work streams you need to accomplish, and those tools either aren't being utilized or people aren't aware of them. And then the hedge fund specific versions of those are fairly nascent compared to other areas of software.
Yeah, 100%. Yeah, that's a funny story there. Reminds me of the Facebook movie. Drop the it's just Facebook. Well, very cool. As far as like kind of just the main kind of potential funds you're going after, emerging managers, what are the conversations you're having? What kind of sets you apart? What's unique from your perspective as you kind of bring people in and onboard them? Obviously, you have a technology background that's unique. You have a different view on how people should have that user experience. I'm just curious what your thoughts are as you kind of have conversations with potential clients and opportunities.
Yeah, so I would describe the fund admin landscape in the following way. I think over time, it's become very barbell-like. And what I mean is there's a bunch of service providers that are really focused on being very cheap. That's their number one value prop. They have a very large offshore labor team, and the managers that go for them are indexing primarily for price. And it comes at the cost of the technology is okay if you actually need to interact with support or you have questions or you need a more hands-on relationship. It's kind of like when you call your bank and Steve from India picks up and next time it's Mark, and every time it's some person, it's slow, they don't have context. So it's not very services oriented at all. And that has pros and cons. On the other side of the market, you have these extraordinarily expensive providers that start in the six-figure range. If you're a $200 million manager, you're tiny potatoes to them. But they focus on really big funds and they're totally onshore. They're very slow moving, but they're very good at what they do and they have huge capacity, right? So this could be like the Northern Trusts or the SS&Cs or, all of the traditional, Morgans and Goldmans have some fund servicing arm. The middle, where there's a little bit of both, I think has hollowed out for whatever reason. And that's really the area we're looking to attack. We're really going after managers who value having a closer partnership and expertise with their fund admin and back office services provider that is onshore and accessible, but is also not necessarily as expensive, right? So we're not the cheapest provider. We're far from the most expensive. We're still a great fit for emerging managers. And that's where we want to sit in the market. And then as far as why people like us in the specifics, I think it's three primary things. One is the technology, right? I think people are just really excited about how much of a step function level up we can drive for, both them and their LPs. And I'll kind of skip over that for now. The other two are the onshore and the client services, which I just kind of touched on, right? And then the last is probably our expertise, which maybe relates to both of the prior two, but we actually, alongside fund admin, like I said, do end-to-end fund launch. And so compared to a lot of admins, we can speak much more widely to fund back office generally. If you go to a normal fund admin, you start asking questions about legal or compliance, you're going to get a little bit of a hands thrown in the air. Hey, go ask your legal and or compliance. But as you guys well know, like in this space, all of those topics intersect with each other. And because we actually do formation and because we actually do advisor and manager, compliance, we can basically be a much more knowledgeable single source of truth. And that's a particularly good fit for emerging managers, because until you're probably, I don't know, $250,000+ size in terms of your book, you probably don't have dedicated in-house staff that is like a compliance officer or some sort of legal officer. And so you really are reliant upon the relationships and service providers that you have to fill in the gaps in your operational workflow and your knowledge. And Repool can actually just take on a much wider spread of those. And that makes for a very, very strong client partnership that also saves you time and resources.
Talk to us about some of the clients that you guys work with. Are there specific maybe verticals, whether it's like hedge funds, private equity funds? Kind of give us the scope of the clients that you guys work with and are capable of working with.
Yeah, we are focused mostly on US connected vehicles foremost. So some admins, if you're like a Singaporean VCC or whatever, they're happy to take you. We really deal with US onshore funds and then US connected onshore offshore funds, with the BVI and Cayman being our focus. And then the other is our asset class focus. We don't do PE and VC. If you have some side pocketing and designated investments, that's fine. But we're not going to take like a standalone PE fund or real estate fund or something like that at the current time. Most of our clients are doing something on exchange with respect to securities or derivatives, and to a lesser extent, crypto, which mostly is a function of limitations around how you can trade crypto in the US. But the kind of core characteristic is that you are an open-ended fund rather than a closed-end fund, and you're trading liquid assets rather than, private or closed assets.
Cool. And then I guess the other, two verticals of your business I'm interested in getting into is just like the formation side. You mentioned formation compliance. Talk to us about that aspect. What are some of the services in that front? Obviously, you guys, sounds like you guys will help set up funds. But why don't you dive into, the full kind of scope of the legal side and, formation and compliance?
Yeah. So this is a model that actually has been pioneered, I think, more on the venture side, which, when you think about a venture fund and a hedge fund, they're ultimately two sides of the same coin. They're just private funds, right? There are some key differences that manifest because of the structure of the investments and the liquidity that entails. But ultimately, they're subject to a lot of the same things. And my point there is venture is a bit more progressive, probably just by design, given what they do, right? So on the venture side, there are some companies that have pioneered this fund launch model where, as a lot of people listening or have ever experienced a fund or are looking into launching a fund probably have realized, most emerging managers have pretty standardized needs. Of course, there's certain things that are special about their strategy, their disclosures, and of course, their fee structure. But at the end of the day, most law firms themselves operate on a template model. It does matter how good your law firm is, so they can figure out which parts of their template and what situations are specific to you. But a lot of times you go to a firm and you get charged as if some lawyer is actually writing this 150-page set of docs from the ground up. But it's not actually what's happening. They're pulling a template off the shelf. Some associate is probably working for a de minimis amount of hours, and then you just get the output of that, but you're charged, 50, 100K. And that's very expensive for an emerging manager, especially given that your first year is the most speculative year where you're most cost conscious. But ironically, it's your most capital intensive outlay because you actually are paying for this one-time formation cost. And on top of that, most emerging managers don't go to great firms because they're trying to save costs. So we see all sorts of offering docs when we were starting a company where literally an actual law firm did it, but they made a copy paste error or control F find error. And there's no reference to the other client whose docs they're clearly copying off of, or they didn't change something, right? And it's not crazy. It's because these docs are huge and there's so many things that you have to contemplate. Our idea was, why don't we work with a blue chip investment management firm? So we work with a firm called Lowenstein Sandler, which is generally considered one of the best investment management practices. They work with a ton of recognizable multi-billion-dollar funds, and we work directly at the partner level. And essentially, we have this. You can think of it as like a library of modular language, and then we use software to put it together. So no one at Repool is ever writing language. We're not lawyers, but the docs and all the language themselves are written by best-in-class counsel. And then what you're entrusting to Repool is that we have done a good job of actually assembling it specific to your situation based on how you want to set up the fund. And so far, we've launched, over 50 funds. And, I think everyone's really happy. We've had other counsel look at our docs and then learn that it was assembled more programmatically by a non-legal firm. And they're like shocked because it looks like a normal set of high quality offering docs. So that's very appealing for folks. And we don't actually care that much about launch. I care about working with the client on an ongoing basis. So in some sense, our idea is we can make it faster, easier, and more affordable for an emerging manager to launch while still delivering a set of legal documents that are high or higher quality than what they would get otherwise, and get them to market, which is the number one thing that matters for an emerging manager. You can start fundraising, you can start building that track record, you can actually get out there and have the rubber meet the road. And then after that, we just roll into the normal things that back office providers do. So the admin, and then you asked about the compliance. I think in short, look, most people, I think, underestimate how much compliance and stuff there is to do. Not that any individual piece is rocket science, but there's just a lot of it, and a lot of it's conditional and requires specific knowledge. Like, in this state, you need a blue sky filing after you've raised from 5 investors, and that state it's valid for 4 years, et cetera, et cetera, et cetera. There's reasons why multi-$100 million funds have in-house staff that all they do is compliance, or all they do is, marketing material review. And we can kind of help an emerging manager take that on and not have to think about it. And that's very valuable again, right? Because hedge funds are very much a game of until you get in trouble, you don't know you're in trouble, right? And so you really want to have confidence that you are just not putting yourself on a path to have pain. And that's what people get with us, is you just have a lot of confidence. Like, Repool is taking care of all these things that I am not aware of or I'm aware of, but I don't want to spend time on.
Yeah, absolutely. And that makes a lot of sense. And obviously, there's a lot of moving pieces and parts with compliance and reporting functions. Obviously, the private funds rule got overturned, which is probably great news for a lot of players in the space. But obviously, the other aspects of the cyber rule coming down, other things that I'm assuming, based when you have technology, that can make things a little bit easier. I know that could be pushed maybe to outsource CFO firm or someone else, but I would think you guys would be in a pretty good position having the tech internally to be able to do some monitoring and reporting if needed.
Exactly. And it's not, look, at the end of the day, I think people get a little touchy when they hear it's a tech platform, because at the end of the day, there's a lot of complexity in edge cases, but we are not like fully just trying to automate everything. Maybe one day, maybe 10 years from now, that will be the case. But a lot of it is getting leverage operationally at Repool and for you by simplifying work streams and automating a lot of the data points that let us figure out what to do. But at the end of the day, we still have people who are powering the services. So it's not this like total, like, okay, Repool is either this like totally tech enabled, automated, software only approach, or I get like this totally non-software enabled back office provider. We're very cognizant of the space we're in. We know people want to have a human reviewing work. We know that people want to have the relationship, and it's more that we're trying to be a little bit in between and use technology to find leverage to deploy into having more overhead to spend on these other services.
Yeah, that makes sense. I guess from a emerging manager point of view and kind of the trends you're seeing, I'm sure you talked to a lot of people and prospects coming to launch funds. From a fundraising perspective, that tends to come up quite a bit as you're smaller, right? Because there's a lot of things you have to do, and are you looking to do? Maybe you're new and you don't know what plan to put in. Do you see some of those conversations? Obviously, you're focused on the operational back office fund launch, but through the fund launch process, that does come up. Right? I'm just curious if you've had those conversations. What's your approach to send them to third party, capital raisers, wholesalers, all the above? I'm just curious, kind of the topics of conversation that come up on that side.
Yeah, absolutely. I mean, because people really treat us almost sometimes more than they should as their partner in crime for all things relating to their fund. We get a lot of questions around that, where people want to have the brain share and they know we work with other emerging managers that we help launch. So they assume, and rightly so, that we see a lot of it. So yeah, we do. I think I guess I would almost phrase it as two things, right? What are the trends we're seeing? And then maybe like what's some of the common themes? I think from a general trends perspective, I definitely think that the biggest thing I see is a focus on having a really polished set of whatever it is you give to your LPs. And this is just human nature, right? As the standard of experience increases. So for LPs, that's both for every manager out there. There are some managers that give a nice set of marketing material, really clean metrics, like they have a data room. And then now there's this rise of alternative investing tools that synthetically proxy access to more and more esoteric asset classes you only used to be able to access through private funds, and that are like fully tech-enabled, web-based. You don't even need to have liquidity restrictions. So what that means is, like, if you're this old school manager that has a terrible tech stack, really crappy materials, the alternative is they can just like not deal with any of that and get a similar alpha profile. And so why would they invest in you instead of some other manager where they get better transparency, or it's easier to interact with, or they can literally just go invest directly in some newfangled ETF that has some complicated derivative structure that allows it to do things that it didn't used to be possible. You have to meet a certain minimum bar. And I think that's definitely something people are realizing and seeing, and the funds that aren't doing that, I think, are suffering. The other is like specialization in terms of asset classes, a little orthogonal to your point, but a general trend we're seeing in emerging managers is definitely people trying to, as a result of what you just said, find exposure that they can offer to LPs and tell a story around that is hard to find elsewhere. And I think those are the managers that have the most success. Nowadays, if you're like just a generic equity long short, you better be raising from a different profile of LP. Because if you're going after the most interested LPs, there's 1,000+ of those funds. There's always someone better than you that does the same thing. And that's really, really, really tough. And so you're definitely seeing a focus on different industries, different geos, different strategies. And I think the era of private funds being dominated by long short will slowly decrease, because why pay a 2% management fee for returns that you can just get by holding a free ETF that you can cash out of at any time? Is the general direction of the theme. I think the biggest tips I have to some of what you talked about is, I do actually think for most emerging managers, cap intro and placement agents are a mistake. It's like dating apps, right? But even more so, like, it's very top heavy. And so if you're not literally the best person or close to the top of your particular strategy for that cap intro person's network, you're never going to find any benefit. And it's such a nebulous service. You're not paying for any guarantees. You're paying for like this vague network of possible introductions with no guaranteed outcome. And it's very appealing because it feels full of opportunity, which is why I think people pay for it. And you think of yourself as the chosen one. That's just how everyone starting a business is. But then most of these people end up throwing 20, 30, 40K in a trash bin over their first 1-2 years with nothing to show for it. The reality is that most allocators want a 3-year plus track record. And when you're an emerging manager, that's really, really tough. So I always encourage people to avoid those. It almost sounds like a shortcut. It's like, oh, like fundraising is really hard, but if I pay this cap intro person, like all my prayers will be answered. It's just not what happens, right? And I was at a conference last week in New York for emerging managers. And in New York, it's a ton of people from, the best firms, people spinning off from Citadel, Millennium, Point72, Balyasny. And these people are struggling to get anything done through cap intro because, again, there's some other better PM who has more experience, that has a fund that's been around longer, does the same thing as them. So why is an allocator going to pick you? I think my tip then is to really go out there and do two things. One, make your conversations real. Behave as if the fund already exists. I talk to a lot of people where I'm like, how much do you have committed? They're like, well, I have this much committed. And then like, I have a bunch of money over here that I'm sure is going to come in. They didn't actually say it will, but like we've had so many great chats. You got to make it real. Like behave as if your fund exists. And the only difference is when they actually are saying, okay, I'm going to give you the money. You say, all right, do that when I actually launch. But I think for whatever reason, and this is not just a hedge fund thing, it's like business generally, people are afraid to actually ask the committal question. There's a huge difference between, yeah, like this sounds cool, I'd consider it, I have a lot of money, I'm really interested, and signing something or verbally committing to doing something. So the shrinkage, in other words, between what people think they have soft committed and what they actually raise is one of the number one things that I see out there. And we really guide our managers against, because we have a mutual incentive. If you fail to fundraise, then you're not going to be around for very long. So I really want to see you succeed, not get happy years, not avoid the hard questions. The other thing is, I think I encourage people to model their fundraise and their launch to the types of LPs they actually can go after. A lot of people, they're going to launch with like $3 million. and they're like, I have to get this blue chip law firm and I have to work with SS&C and I have to get like KPMG to audit me. I'm going to have like a $300,000 expense ratio because these service providers are like, great. And when I'm raising from these multi-billion-dollar family offices, need to have them. It's like, look, solve for the problem you have. If you get there, you can adjust and you can have those people. But today, all you're doing is obliterating, your margin and your alpha through expenses. And no one cares about that. No one's like, oh, I would invest, but you're using, a top 25 auditor instead of a top 4 auditor. That's just like a weird, false god that a lot of managers feel attracted. Like, I have to have the best providers. Like, why? The number one thing that matters is you deliver returns. It's just a very strange phenomenon. So there's that. And then there's also like, pick your spots. A lot of people only go to conferences in New York to meet New York allocators. A lot of people are better off go to like Dallas and go after those people. If you go to New York, you go after allocators, you're competing with all the guys from every firm on the street. You go to Dallas, you're not. And so I actually think there's a lot of leverage to be gained by having a unique thesis on who you're raising from. And they don't need to be the tier 1 city, huge offices. So a lot of the funds, as a last note, that we've seen surprise to the upside in terms of their raise with Repool, and we almost exclusively work with emerging managers, are people who are raising in like really random geographies because you're just playing a different game and you're competing with a much thinner field. That's a great place to be. So there's a very long answer, but those are some of my thoughts to your questions.
Well, that's great. I think that's helpful.
Yeah, really good
points. That you obviously are kind of end to end. I just kind of thought you get probably a lot of those things coming at you, and that's a great insight into kind of what people are looking at. That's great.
I'm curious, in terms of, I do want to ask you some more questions about the hedge fund. I really like the insights you just gave, and I think there's more to come on that front. But I do want to talk about the technology stack for your company. And talk to us a little bit about some of the things that you guys are doing differently on the technology side, whether that's the data in terms of how you're getting the trades. Maybe talk to us about the AML KYC side. Talk to us about some of the benefits that you guys are using on the technology side.
Yeah, I think a lot of it has to do with the workflows that are mutually shared between LPs and managers. So it all actually starts from day one when you're getting an investor to subscribe. There's a bunch of things I think we do that are novel. So I put it in 2 ways. One is how well we do the things everyone else does. And then 2 is the things we do that traditionally you have to go get somewhere else or you don't get at all. So maybe starting with the first, right? The subscriptions for most admins is like you either fill out a subbook manually or it's been DocuSign templatized. But it's still, at the end of the day, for those who are not familiar, this intimidating looking 50-page esoterically written legal document with like a ton of questions on it, many of which don't apply to you. So it'll be like, if you did this, don't forget to fill out, question 8C3, but don't do that if, A, B, and C are true, right? And so you'd be surprised how many allocators make mistakes because it's just one of those things. I think most people, even when they're hyper competent, you get a esoteric set of legal docs and your brain just kind of like withers away. So the industry stat for the number of subbooks that have errors is really high. And that sucks because then you have to go back, you have to ask them to fix it. They're going to ask you why, what's wrong. They have to resubmit because it's a legal doc. You can't just like white out the answer and put in a new one. You got to redo the whole thing. And so I think a lot of emerging managers underestimate the pain, the time, the back and forth and consideration associated with just getting the damn subbook signed. And so for us, as an example, we actually have a totally different approach where we take this, what I call TurboTax-esque like approach to our subscription. It's a digital flow that totally abstracts away a subscription booklet and uses software and basic conditionals to enforce the right answers and only put the right questions in front of subscribers. And basically it's brainless. Like a natural person subscriber can subscribe in like 10 minutes. And unless they make a mistake clerically in some input, they're never going to skip a question, never going to ask the wrong question. There's a lot of these variations, right? Like a common one I see is someone's an IRA subscriber. They're going to invest through their benefit plan, but they put down that they're an entity because they're actually investing through like, say, Alto IRA or Madison Trust. So they're confused. That's incorrect. You're a natural person subscriber, but you're being subscribed on behalf of an entity. And weirdly, you subscribe as a natural person. This is a super common subbook error. And it also involves you tagging in your benefit plan and administrator to complete part of the subbook. We basically make that super easy. You can invite someone and we'll basically tell you, like, you are trying to subscribe to an IRA. You can't do that, right? So what we see as a result is people subscribe quickly. They make way fewer errors. And then the whole cycle is digital. We ping the manager. We show them all the answers. We flag what's, wrong or troublesome. And then you just kind of digitally sign. and you're good. And at the end, what's cool is we still generate a physical sub book. So you still walk away. It's just that when you're actually subscribing, you never have to see it. And that makes the subscription experience a lot more pleasant. And so we've been actually surprised how much value that's brought even to some of the institutional allocators that have used our platform, because even for them, it can be quite painful. So that's just one small example. And we try and have a lot of those thoughtful touches through the entire platform around providing context. For the second part, which is like things that other people don't do or you have to get from other tools, as I said earlier, a lot of what you do as a manager is kind of like general business work for like almost CRM. So one use case is like data tracking. A lot of more established managers that have a higher expense ratio, they can afford will buy CRM or they buy data room tools separately. But a lot of emerging managers won't or can't or don't want to. And so we actually have a lot of that functionality in Repool. I'll give an example. You and Repool can use Repool as the point at which you send your offering material rather than just the subscription later on. And we'll actually track who's viewed it, when did they download it, how many times are they logging in, what are they doing? And we give you insights like which LPs are engaged, which ones are actually doing things. That's incredibly valuable. It allows you to understand whether your expectation of who's actually going to do what is matching reality, and then also who's not doing things, rather than a traditional flow where you've got some Google Drive or email and you just email 30 prospective LPs offering docs. Just think about that problem. You very quickly have no idea what the hell anyone is doing across 30 LPs. You don't know who to follow up with, when, if they're doing what they're supposed to. It actually is a huge problem. And we have a centralized dashboard where we tell you, like, here's everyone you invited. Here's exactly what they've done. They've created an account. They're starting to subscribe. They've opened the sub books. They haven't. They've only looked at the offering. They've logged in 17 times. They've logged in 2 times. That's just like really empowering as a manager. And we bring that all in. So those are, I think, the kind of 2 examples I'll give. And my last note is, in general, I think there's a lot of opportunity for us, and where we're most excited is to expand upon those types of use cases and continue to facilitate digital flows around things that are traditionally either not done at all or extremely manual. And I think that's why clients find working with Repool to be exciting, is not only do we solve problems for them that aren't traditionally solved, but the velocity at which we add new solves and new functionality is really compelling.
Yeah, absolutely. That's great. A quick question, Kevin, just regarding, you mentioned emerging managers you kind of primarily work with. Are these all primarily new launches, or do you take on existing clients and maybe move from one avenue to another? I'm just curious that process.
Yeah, it's a blend of both for sure. So I would say historically, we have primarily focused on new funds, but in the last 6 to 12 months, we are a lot more of a split. So one of our most recent clients is rather, a fund that's 3 or 4 years old, and they have a master feeder USBVI structure, and they're switching off of their admin to us, which is exciting. And so a little bit of both. It just really depends on what you're optimizing for in your stage in the fund.
Yeah, that's great. And I know that's a big pain point for managers and service providers in general to move from one service provider to another. Historically, it's been a painful process. I'm just curious if you guys have kind of thought through some operational insights and automation or anything that's helped that process make that a little bit better from the manager and everybody involved.
Yeah, I think the way we've done it is mostly taking on the lift ourselves. And a lot of the tech we've built is like internal facing to make it easier for our team to ingest. So I do think we make it less painful. At the end of the day, any transition still has some friction. So we certainly never want people to think this is just like walking through a door. But our promise to clients, and this goes back to our model, is because we have some technology leverage, we can afford to deploy resources into, personnel and resources that other admins don't. So at a lot of other admins, it's a very like, I need all of these things and you need to give me all this stuff. And for us, it's a little more like, we'll take on, maybe 50% more than that admin will, and we'll figure it out ourselves to lighten the transition. And that certainly helps with making the transition off your existing service provider to us a much lighter and less mentally intensive task.
That's great. That makes sense. That's excellent.
Talk to us about future trends in hedge funds, in terms of compliance and regulatory side of the business.
Yeah, so I don't know if it was when we were recording or not, but earlier we chatted briefly about how the new private fund rules got struck down, which I think most managers were excited about because they were very intense. But I think the trend in general, and what that points at, the attempt to even pass it, and the general trend over the last 30 years is there's going to be more oversight, there's going to be more compliance. It might not be the specific manifestation of the private fund rules, but it's more intensive than ever to run a fund in terms of the obligations you have to your LPs, the record keeping, And I think that trend will only continue. I know a lot of managers complain, but I am also sympathetic to regulators because as an admin, I actually see a lot of funds and I run into a lot of funds, and what they're protecting against are the people who are bad actors. And there's just a lot of them. That's just how financial services is. And so with the improvement in regulators' abilities to process tons of info as they level up their own regulatory tech stack internally, they feel it's appropriate and have the capacity to demand managers give them more things, which they're now capable of reviewing. So I think it was something like 20 years ago, probably only like 25% of funds were externally adminning. Now the stat is closer to 60 to 70% have an external admin. And I think over time, that number will basically get, asymptotically closer to 100%. And so I think the point there is that you definitely need to have a plan for how you're going to stay on top of trends and changes, because there's no like, I'm a hedge fund, now I'm part of this like group or email list and the SEC tells me every time I have to do something. They just push regulation and you need someone who's tracking that. So you either that's an internal hire or an external partner who is telling you when things are coming, and in good faith also when they actually apply. Because a lot of compliance folks that we run into are very heavy-handed and they make firms do things they don't actually have to do. And I don't know if that's just being conservative or if that's because it's an easy way to talk your own book by asserting your expertise in an area the manager doesn't. But that also can be annoying to slow yourself down before you have to. So I think just in general, that the point is that realize that running a fund is at the end of the day a business, and it's a very regulated business, and that regulation is increasing. And so I do think your partners matter, and Repool by no means is the right partner for all of those things either. I think you have to realize that as your fund grows, you're going to end up having to solve a lot of problems and it will become more painful. And that's the story with any business in any space. It's also true for hedge funds. I think a lot of managers have this slightly hopeful view that, if they hire the right people, they'll never have to hire someone ever again and they'll just keep running the fund forever and it'll all be the same. And it's just not how it goes. So I think that's like one big operational trend. The other is indeed what we already touched on. So in short, it's just, I do think that when you look at the assets that are trendy and have continued to be trendy and look like will be trendy in the future, it's funds chasing more novel exposure, because that's the type of strategy that is compelling to LP. So right now, private credit is a huge, very trendy asset class. And it's because there's no good public instruments that allow you to access it, right? But if there was like some ETF that essentially synthetically proxied private credit and was fully liquid, then I bet you would see fund managers move to something else. So it's not that you have to be on the cutting edge. And certainly that's a terrible way to be an asset manager, is to go chase assets you don't understand how to trade. But I do think you just continue to need to have a sharp thesis on, as the market evolves, not just from like a how does that affect your trading strategy, but also what other investment opportunities are there for allocators that look like yours, and how do you stay ahead of them and continue to have a differentiated offering is going to be really critical.
Absolutely. Love it. And in terms of I'm also curious to get your thoughts on the future of fund administration. How do you see the fund administration market, evolving over the next 5-10 years? Obviously, there's going to be more and more technology. Like we talked about some of the things like AML, KYC, maybe different ways to get data, but I'd love to get your thoughts as the fund administration industry as a whole.
Yeah, I mean, I think it's generally good for managers in that, as we alluded to earlier, there's pressure now for admins to change their behavior. I think the earlier context was because of COVID. But look, in any industry ever, once there is like a new, better way of doing things, some wave of people will start doing it that way. And then eventually it'll become unacceptable if you're not doing things that way. So I do think having a admin who has a clear path on how they're going to adapt to the times and bring technology to the space is going to be essential. Nowadays, there are still plenty of funds that operate with fully manual, everything's on paper and email service providers. But I think, again, like that's just going to become an increasingly unacceptable state of affairs, both internally and externally, over the next 5, 10, 15 years. So I think that that's the trend. Is I do think you'll see all admins move towards being much more tech enabled. And that's really great for the actual asset manager community. I think the other thing that we kind of expect to see is indeed the continuing barbelling of the services industry. Because these are services companies, it is actually hard to be a middle provider in that, like, you are not the cheapest and you're not the most expensive. And that's why we've taken our approach is technology, we think, is the answer to having the ability to stay there. But I think that there's going to be really, really, really cheap providers, and then there's going to be really, really, really expensive providers. And you kind of have to figure out for yourself as a manager what's important to you. I think there are plenty of situations where a manager who has a really simple fund, who understands everything they need to do, is a great fit for a really cheap provider. And then there are situations where that's like nonsensical. So I think it's having an honest self-assessment on what are the problems you're going to encounter? What are the assets you're going to trade? What's your future as an asset manager as you launch new products, new funds, and grow? You need to pick a partner that will like scale to your foreseeable likely future. But I do see a lot of that. And I think when we run into the fund managers that endure, they always end up becoming like multi-product asset managers who are doing many things. That seems to be very much the trend. And so having like 7 different admins for 7 different products is not a very good way of going. And so you definitely want that kind of scalable partner. So last but not least, I think there'll be consolidation. That's always been the case in this space. So I don't know whether that's a good or a bad thing, but big players keep buying the small players. Every year someone gets snapped up. I hope that the industry doesn't end up being like 3 admins that, you know, if you're this, you pick this one. And if you're that, you pick that one. I think competition is really healthy. But I do think you also want to evaluate whether your admin is on the up. And there are certainly admins that are growing and expanding and succeeding. And then there are admins that are like, you know, retaining their customer base, not getting very many new customers. And the risk there is if your admin collapses, then you're going to be in for a world of pain. And we've actually seen that play out a couple times in the venture admin space already, less so in the hedge fund space. But when it has happened in the venture fund space, it's been really painful for folks, right? Like Twitter explodes and all these managers are desperately scrambling to migrate because regulators don't care that this happened for you. You still got to meet your obligations to investors and to the SEC. So yeah, those are my thoughts overall.
Yeah, that's great insight, Kevin. And obviously, you mentioned the consolidation, which has always been happening on a yearly basis with various admins. I would say though, when you see the consolidation, if you're not tech driven, it's even more painful. You go, 2 different players trying to consolidate their books and records into one large admin group. It tends to be painful as well. So I think to your point, it's going to have to be a tech solution that everybody is the bar is going to be raised for everybody, right, going forward, to have that in-house to build and be able to truly provide scale to your underlying fund manager clients, which has always been a challenge, right? There's always a ceiling or bottleneck that many funds run in against with their service providers traditionally, I would say, with the lack of technology and manual intervention and lack of automation that happens. To your point, you still need a human in the loop. You still need the experts in the room, but you need to be able to enhance what they're doing with unique technology and forward-thinking pursuits and approach. Absolutely. That's great.
Cool. Anything you want to talk about, Kevin, that we haven't brought up yet?
No, I think we've covered a lot. And I think you guys have given me a lot of time to ramble at length about my thoughts on both why Repool is an interesting solution for managers and also just general thoughts on the industry. So out of everything else, I'm certainly very appreciative of your guys' time for having me on and for running through all these topics with me today.
Where could people go to connect with you and learn more about Repool?
Yeah, the best way to find us is definitely our website, just repool.com. That's repool.com. And, you can also email me directly. I'm Kevin@repool.com. I really like to stay close to clients. So even if it's not, hey, I'm going to use Repool today, we really, really value actually just like hearing what people care about, what problems they have. We have a bunch of folks that are at larger asset managers that we stay in touch with that don't use us in candor because we're not ready for them, but they are optimistic about our ability to build things to solve problems for them. And, they just tell us what sucks for them or what workflows are painful or how they're thinking about the future. And we love hearing that feedback. Otherwise, we have LinkedIn, we have Twitter, just look us up. It's Repool. And, anyone who checks us out, we're very appreciative of your support.
That's great. We'll make sure to include all that in the show notes, Kevin. That's amazing.